Good afternoon, ladies and gentlemen. This is Chad, DK305007 with Free the Trade. And today we are going over basic information on how to set up a trading plan for a beginner investor or trader. Let's hop right into it. That would be our intro.
Right.
All right, Education. Cedric, how you doing, man?
What's up?
Hey, come on, tell us a little bit about what you would do or what you would recommend a beginner investor.
Okay, well, first of all, a person that has already learned, they already have built let's say you've already built a portfolio, and like now you can, knock on the door of day trading options or swing trading options. But I don't think you should, if you're new to this, you should focus more so on understanding the concepts and the terminology. And so you're in school right now, that's what you should be studying. But you should, if you don't have a portfolio, I don't like people that trade and don't have a portfolio. I mean, you can, because that's the purpose of doing options, is to be able to benefit from the price movement without actually owning the stock. But you should build a portfolio too. It's like a balance. You should focus on, and what is a portfolio? That's where you start investing in some of these companies and owning some of these shares, so you could be a shareholder and think about the long term. Don't just think about the short term. Don't just think about today or tomorrow or next week. If you're new to investing, know that there's short term and then there's long term, and that you really want to find a healthy balance of both and not just be focused on these options, because they will screw you.
That's a really good or a really important point. It is really nice to have a portfolio. And if you already have a portfolio, well, I'll just from my personal experience, when I started trading, it took me about 4 years of trading with shares. I built up a portfolio. I learned all about the stock market, about the underlying equities or securities, which is the stocks or companies. And then from that point, I started learning options. Options took me another at least 4 years before I was to a point where I was just very comfortable with them. And then when we started looking into the advanced options and level 3 multi-leg strategies, that took about another year before I was really, really comfortable with those. So a really good point. Start at the basics. Don't try to jump straight into the options and day trading, or you'll burn yourself out and potentially blow your account. So really good point.
Yeah. And I mean, I know a lot of people don't recommend paper trading, but paper trading can help. You just, the secret to paper trading is your ability to use your imagination. You have to feel like you're losing real money with that paper money, because the moment you start trading with a live account, it'll hit different. It'll feel different than it did with that paper money, because you're losing or making real money. So it's going to create another level of adrenaline, another level of FOMO, and all this extra shit is going to kick in when you start trading with a live account versus a demo account. But if you can trade in that demo account with the idea of, hey, I'm only going to demo trade with 2,000, because that's what I'm going to start my live account with, and treat it like it's real, because the price moves a little different than in reality on a paper account. But it's worth the practice that you learn. You get to learn whatever interface you're going to be trading on. That's what that helps you do. It isn't so much about learning how to trade paper trading, but it teaches you how to use that interface and become familiar with indicators and price action.
Yeah. So let's actually jump in and pretend that we're starting out with a $2,000 account. What's your strategy? What are you going to be doing
Well,
with that?
if I have a $2,000 account, and this is me with a portfolio already built, because if not, I tell people half of that needs to go towards building a portfolio, and you can possibly trade with the other half. But if you already built one, you've already got some stocks that you own, and you have 2,000 in your account, you're not taking $2,000 trades. You're not taking $1,000 trades. More than likely, every trade will be around $100. And then if I'm gonna use $100 on a trade, I'm gonna try to trade with at least 100, maybe two at the most, but $100. And then if I can keep my stop loss set around the same, I want to make sure that out of that 100, if I'm down let's say 10, and I can make it a little deeper, $20, I'll get out of the trade. But that's my level of tolerance. Your level of tolerance can be different, but if you come up with a strategy, if I stick to that strategy of only trading with 100 and getting out when I'm losing 20, then I only need to be right a few times out of 10 for me to cover all the losses that I would take, because you will take losses. This is about probability, not predictability. It's not about you being right or wrong, because you just need to cut the losses short, right? See them early, cut them short. Don't hold on to the losses and then cut the gains short. You let the you let the gains run. You cut the shorts. You cut the losses short. That makes sense.
That's a really good idea. For me, if I was starting with a $2,000 account, I would actually do something quite similar. First of all, I'm going to split my portfolio in half. I'm only using 50% or less of that in active trades. I'm also probably only going to, especially starting out, I'm only going to be in maybe 3 trades.
3 trades, what, a week or a day?
At the same time. So like if I'm in trades, if I'm trading, I'm only going to be in 3 separate tickers at the same time. I'm not going to be spreading myself over 10 stocks. Because that's just too much to manage. Pick 1 or 2, maybe 3 at the most. So that's what I'm doing initially. Second of all, I'm definitely
100 trades with one stock, with one ticker. Try to get just familiar with a ticker.
Yeah, for sure.
I mean, that'll help you out too.
So anyways, I'm focusing on, just a couple of them, only 3 maximum trades at the same time. From there, what I'll do is I'm going to sit down and I'm going to develop a very well thought out strategy. You mentioned not letting your losers run and letting your winners run. Part of that comes down to just having a plan. When am I getting out? And how long am I staying in? What am I looking for? What is my take profit level? And I think that's one of the biggest thing people don't get or don't do, is that they'll jump into a trade and they won't know, where do I put my stop loss and where do I put my take profit? And so they'll either say, hey, I'm going to hold for a certain percentage gain, or I'm going to, if I go down a certain percentage, I'm going to get out of this trade. And while that can work, that's not a high probability. That's not really a good strategy to do. For me, in that $2,000 account, I'm trading with $1,000. I'm wanting to keep my losses to a minimum. So I'm looking for A+ setups. I'm looking for B setups, and I'm maybe taking only like 1 C setup. But mostly I'm looking for those high quality setups. I'm setting up my stop loss extremely tight at previous levels of support or resistance. And I'm setting my take profit at realistic goals at previous supports or resistance. And what that does is it gives you something to work for. And if your trade goes wrong, say you're heading for that take profit and your trade goes upside down, number one, you can recognize immediately that it's no longer a valid trade. And number two, you'll probably still be in profit if you're watching the charts rather than a percentage. And so that's going to help you let those runners run and then cut those losers even before they're out of profit. So that's one of the things I'm doing.
So by $1,000, you don't mean like $1,000 on a single trade though, right?
Oh, no, absolutely not. If I have a $2,000 account, once again, I'm splitting it in half, and I'm going to have 2 opportunities with $1,000. I'm only trading that $1,000. As I make more money and profit and stuff, that profit's going over into the other side of the account, maybe into an ETF or a SPY. Sometimes I'll do like a 30% into another ETF while I'm trading. That way I'm growing my trading profit, but I'm also growing that backup fund in case I ever blow my account. But yeah. And, ideally you only want to risk. Oh, go ahead.
Go ahead, Chad.
Okay. Ideally, you want to risk like 1 to 2% of your account on a single trade. That doesn't mean you're only going to take a trade that costs 1 to 2% of your account size. It means that you're only willing to lose that amount. And so if you have a high quality A+ setup and it's like $500 to enter it, and you're trading with $1,000 account, you can take that, even though it's a 25% of your account that's in that trade. You can take that trade if it's a high quality setup.
Yeah,
You
and
will
as
need to
long as
back up.
you have a choice to, as long as you're ready to get the fuck out when it's not going in the right direction.
Yeah. Would I recommend that for everyone? Probably not. You need to learn when a trade's going wrong and when a trade is flipping on you before you start doing the larger trades. And doing
Yeah.
those smaller trades is going to give you more opportunities, like Cedric said, to practice and maybe make a couple mistakes without blowing the account.
Right. And if you wanna let's like if paper trading gets too boring for whatever reason, it shouldn't though. But if it does, then you can just come here to the real charts and pretend that you bought a call to see if it's going to go in the right direction. And if it doesn't, you will see, damn, I would have been wrong as hell. I would have lost money there. But another important part of your beginning journey is to journal everything. Get used to journaling, bro. Get used to writing down what you were thinking, like what made you take the trade, the date, the time, What else should be in a good journal, Chad?
Oh yeah. You definitely want to have your trade. First of all, you've got to have a trading plan. If you don't have a trading plan, don't trade. Like it's basic and simple. If you're starting a journal, let that be your first page. Let that be the top of every single entry. Here's what I'm going to do: risk less than 50%, or use less than 50% of my account to trade. Maximum loss 5%, 2%, 1%, whatever you decide. Now you go to your trade. Hey, I'm entering here. This is why MACD is crossing over. RSI is it's oversold. So that's a bullish setup. So I'm entering long. I'm waiting for the 15-minute to bounce off the EMA to enter. Okay, boom, it bounced. I entered. Now what am I doing? I'm watching it trade along the trend line. It broke trend. I'm taking out because that trade broke. I'm out, taking my profit right there. I made 20% gains. That is my trade, and that is my trade journal. Tells me why I'm in it, how I got out, and what happened in that trade. Go ahead.
Right now, fast forward the next day, Chad goes in his journal and he's able to see what caused that trade or what he was thinking, what he was feeling, what transpired to make that trade profitable. And now you have a textbook setup. You got your own strategy. If you can now rinse, wash, repeat instead of
And
just guessing or gambling.
say you place a trade and it looks like it's going upside down on your trade, and you kind of back off of that trade, and you go back and check it the next day and you see, oh, it hit my take profit. Then you go and you analyze that chart and say, what did I see that made me scared and jump out or think that trade was going bad? And did I miss something? And sometimes you didn't miss anything, and it was just a news item or something that pushed it over your take profit, and you did good. Other times, say maybe you missed that, oh, I was looking at the EMA, it wicked through, I got scared and turned and closed that trade, but instead of going all the way through and closing below the EMA, it actually bounced and continued up. And so maybe that wick through, next time I'm in a trade, I'm remembering, hey, make sure it closes before making that decision. Don't let a wick scare me. If it bounces through and then bounces right back up, it's still good.
Right.
So you can learn from those trades and stuff if you journal and remember what happened. Cedric, what do you think the most important, if you had to go back to just beginning or becoming an option trader or a day trader, what do you think is the most important lesson that you learned? Is it the Greeks? What is it for you?
Man, it would be risk management. Risk management is important because, as I stated before, it's not a matter of if you will lose money. It's a matter of when. And if you can control how much you're losing, you really won't be able to control how much you make. Like that. I mean, you let those run. But if you can control how much you lose, you'll live to your account will live to make another trade. You can trade another day. Okay, don't freaking don't downplay risk management. Okay, like just, and I know it's like, what do you mean? But it's pretty simple. When you enter that trade, ask yourself, how much am I willing to lose? How much can I lose and it won't hurt me and I won't be bothered by it? What is that number for me? because people that number varies. It's not always 5%, 10%. Some people that number is non-existent for them. And if your bank account and your account ain't set up like that, don't be trying to play the stupid games and get stupid prizes, because trading without one, or with a stop trading without a stop loss, or without using any risk management, is like saying I'm gonna enter this position and I don't care how down it is.
Bad
It
idea.
could be down and they just don't care. But you definitely don't want to do that on a margin account. If you don't know the difference between margin account and a cash account is where you can take an unlimited amount of day trades, but the cash has to settle. You can only trade with settled funds. In the margin account, they let you trade with unsettled funds, but you are met with the rule, unless you have 25 grand in that account, you can only take 3 day trades within like 5 trading days.
Yeah,
But
with a five day rolling period.
right. And then if you not upload, sorry, if you deposit a certain amount, they will give you credits to trade with. So let's say you only got 2 grand. That well, you will have, just hypothetically speaking, like they'll give you 10,000 to trade with, but you can lose more than you actually have that way.
Yeah,
So you will end up owing them.
basically margin account is like a dynamic loan. So if you have $1,000 in your account, actually I think the minimum is if you have $2,000 in your account, a brokerage has the ability to extend you up to 25% of your account balance or holdings as a loan. Some of them are interest free to a certain amount. Others are not interest free. And kind of how it works is if you're using it, you're using margin. So say you have $2,000 in the account, but you have $3,000 in buying power because of that dynamic margin loan that they're giving you. If you buy $3,000 worth of stock and that stock goes to zero, you lose $3,000. You lose the $2,000 you put in there, and then you owe the brokerage back $1,000 because it's a loan.
That's right. That's what makes it dangerous. And that's why you
Yes.
don't want to do it. But if you know what you're doing, then that's it can be an easy way to make more money than what you would. But I don't
Sure.
recommend it at
It's
all.
extra
I don't
leverage.
recommend it.
It's extra
Yeah,
leverage. Don't do it if you don't know what it is.
that's it.
That kind of segues right into what I would, or what kind of I had to learn when I first started trading options as well. The very first time I placed an option trade, excuse me.
We had 620 on SPX too, by the way, you guys.
Yeah.
We got one candlestick. I think this one will be the one to close above 618 too. But my bad. Go ahead, continue, Chad.
Yeah. So the first time I ever placed an option trade, I had a buddy of mine. He was trading options all the time, and I wanted to learn options and was reading about them, but I hadn't yet placed a first trade. Didn't really know anything about options. And my buddy was like, "Hey, I'm going to buy calls on TQQ." And so here I am. I had a decent sized portfolio, had enough money to make a trade on TQQ. And so I bought calls with him. He told me the strike price. I bought them. The only thing is, he forgot to tell me when he exited. And I didn't yet understand that options have an expiration date. I didn't realize that they're continuously losing value every single day due to theta decay. I didn't understand enough about it to even have made that trade. And now I'm not blaming my buddy for it, because at one point that trade was in profit, and so definitely could have made some money on it. But I was used to holding shares, and so I thought, hey, it appreciates in value the longer you hold it. I'm just going to keep holding it. I didn't understand it was a derivative of an underlying, and so ended up losing that money because they expired worthless.
Right.
So the first thing I would say is, if you don't understand options, don't place that first trade. Instead, go read about them, go ask somebody about them, get a good understanding of options before ever placing that first trade. Now, Cedric, I think this is a good opportunity. What do you think a beginner trader who doesn't know anything about options, what do you think they need to learn about options?
Well, because options are one of the most complicated markets to be in. Like it's harder than futures, it's harder than crypto, it's harder than forex. And one of the things that makes it like a little more complicated than those markets is the Greeks. And people skip right over that. They skip right over the Greeks. They learn the Greeks last.
Now, what are the Greeks?
Well, just to give it, I'm not going to use trading terminology. I'm going to use kitty terminology. The Greeks is some nerdy ass numbers that matter, that tell you. He was just talking about how the expiration date matters, and it brings down the what's the word, Chad? Intrinsic or extrinsic?
Well, both. Both. Extrinsic value is like your the outward value of the stock, like it has the potential, and the intrinsic value is if it's in the money and it's currently valued at that. Like if it were to expire right now, this option would be worth X amount. If it's out of the money, it's going to be worth zero at expiration. If it's in the money, it's going to be worth,
Right.
a percentage of what it's currently trading at.
Right, right. So with that being said, the Greeks help you understand how much value that option has, how fast it is gaining or losing value, how much you are paying to hold that position, because all of them have like a price of doing business.
Yeah, and even more than that, the option Greeks determine the price. If you want to bring it down to the simple terminology, option Greeks are an algorithm or a formula that determines the option price.
Yeah.
Now,
Yeah.
what would you say the most important Greek is?
Okay. I would say not. See, and I wouldn't. It's not. It's not theta. I wouldn't say theta, and I wouldn't say. I want to say delta. For me, delta, because all right. Correct me if I'm wrong. The gamma changes the delta, not the other way around.
So, so let me break it down. So there are actually there's what's called the first order Greeks, which are your delta, your gamma, your theta, rho, all these different numbers that have different effects on the underlying price of the stock. And then you have what's called your second order Greeks. Well, your second order Greeks are things like speed, vana, charm, and you have your third. So what's going on is you have all these stacked Greeks. Most people only learn the first ones, but say delta. What affects delta? Well, that's your second order Greek that affects it, and it tells how fast the delta is going to change as the price nears that stock strike price. But I personally, for me, I think the two most important are going to be delta and theta. But it's kind of a hard question to ask which is the most important, because I think it changes based on your positioning in the trade and how close or how far you are away from the expiration date. So
I guess a more personal question would be, which one do you look at the most? Which one do you take into account? Even though you can take them all into account, but there are certain ones that that stick out. Like if what do you use the most in your? I noticed that you use gamma in your strategy. And you're
yes, I do.
Trainer.
I do use gamma quite a bit, but I personally, from my strategy, the two most important are going to be delta and theta, like hands down. Gamma is great for extra confluence and extra confidence in a trade, and once again, confluence is just multiple indicators saying the same thing, so I can use that number to tell me if my thesis or my technical analysis is right. It also gives me an idea of where, say, certain levels on the stock market are, where the price will head to, where it will go away from, things like that. But the most important is delta and theta. So delta is an interesting one. Basically, it's usually from 0 to 1, and it's
really never at 1.
Oh yeah, almost never at 1. The only time it will be at 1 is if it's deep in the money. And delta just determines the stock's, the rate of change of the stock's price. Now, it also has a secondary utility in that you can take the delta number and you can use that as a percentage of the probability of that stock being in the money at expiration date. So if I have a 30 delta, which a 30 delta is always going to be between 0 and 1, so it'll be a 0.30.
That's a 30%
if you can see,
chance.
yes, if you can see my screen here. Let's see.
I hope y'all understand that. So when the delta is that, whatever that delta is that, you can look at that as a percentage of how likely it is for that to end up in the money.
Yes. So if you look here, I have options trades going on right here. I'm actually going to close this out. I don't want to confuse anyone. Here we go. This is our expiration, June 10th, 2025. That's when these contracts expire. That means at that point, you either have to exercise, which we'll get into that later, or you have to sell that contract before this date. So our delta is going to tell us the probability that this strike price, right here, the strike price is going to be in the money. So right now, the price is trading a little below 602. It's at actually a 601.91, so right below 602. This one has a 49% chance of being in the money when it expires on June 10th, 2025. If you go into the money at 601, we are in the money. It has a 58% chance. As we go further deep in the money, it has a 99% chance that 585 is going to be in the money at the end. There are 100% chances, the 576, 570. Once again, these do change as the price moves. As you can see, this one is now 50%. We're right at 602. But yeah, these can be seen as a percent chance. And so a lot of traders will use these and say, hey, buy the 30 delta or the 30% chance option out 30 days. And that kind of seems like a magic number because you get a cheaper call. It's cheaper than holding the underlying. And as price approaches it, this changes. The value of this stock changes. The delta, if you want to look at it at the very base level, is how much the option increases in value for every $1 move. At 602, this option at 185 is going to increase by 49 cents. So 1.89 plus 0.49 at 602. So as it moves up to 603, that'll be somebody help me with the math, 220 something.
Let me interject real quick before you continue. I threw that out there as far as Greeks being one of the first things I think they should learn, because it is one of the it is considered to be complicated, and they find it difficult. They find it tedious. So if you get it out of the way first and you understand it, it becomes nothing to you. It's not even a big deal, right?
Right. Yeah, it becomes really easy. The second most important one, though, is this theta right here. Theta is going to be the amount that your option contract loses its value each day. So
I call it the price of doing business.
Yeah, sure. It takes money to make money, right? The interesting thing with theta is that theta is a exponentially increasing number. So let's go out a long ways. Let's say we go out 30 days. Let's take a look at the theta on these. Let me see what we can do here. I'm going to display theta. Okay, it should be displayed. Let me see. I'm going to move it up so we can see it. All right. Well, somewhere. Let's just... They're making me nervous now. All right. Yeah. So it's displayed. Let's see if we can find it, though. That's the problem. I put it right here. Where did it go? I just lost it. All right. There it is. And I'm going to pull out delta. I'm going to pull out a lot of these so that we can make sure that we see theta. Actually, I don't even think this is on my charts. This is for my bottom level. Okay. All right. So theta here is 3.135. That is not the proper one. Let me see. Do, do, do. All right. So if I'm buying a call, this is a $3 call. Theta is negative 2.499. That means that over this next day, which it's a 0 DTE, meaning it expires today, but over this day, it is going to lose $2.49 every single day. So this option will be worth 0, essentially, at the end of the day. Now, if we go out to a further expiration date, say we go 193 days out, you're going to notice a difference in that Theta, yes, it is decreasing still by $10. This should not be, this is the entire amount though, hang on. There should be a number here. It's like 0.3 or 0.1, and basically that's how much your option is decreasing by each day. Every day that's going to change and update, but it starts off with just like a cent, and then it goes up from there. And as you get closer to expiration, it exponentially increases until on the last day, it's going to be decreasing by the amount the option is worth. So in this case, about $50. But yeah, Theta is time decay, basically. You can look at it and say, hey, the price of doing business, I'm losing money by holding this contract. I'm losing $1 a day or a cent a day or how many ever, whatever that price of your, or whatever that that number is, which I still am having a hard time finding where I can put it up here. I'll have to look into that later. Cedric, thoughts on Theta decay?
Yeah, I mean, I'm going to be super honest. I'm going to be fully transparent. I don't give a fuck about the Theta. It never scares me away from an option. I've never looked at it and been like, oh, I can't enter this because of the Theta.
I would say for the most part, I'm that way. Theta decay is why I don't do 0 DTE or 1 DTE options. If I'm doing, if I'm day trading, I'm going to be doing like a 3 DTE or a 5 DTE. Give myself a little extra time, because on the last day of trading that option, if it's decreasing 100% in value, then if you hold it for an hour, what is that? You know, if you have an 8-hour day, that's a whole eighth of a percent. That's a whole eighth of your cost. So that's the only time that I'm buying options and I'm worrying about Theta. On the other hand,
why I said that though, like I said that because I don't mind paying the price of doing business.
Oh, well, no, for sure. Especially if it's further out, like a further out option. Like I don't even look at Theta decay because it really doesn't matter until you get closer to your end of expiration. So
that's right. That was the key part right there. What you just said. It doesn't matter until when?
Till you get closer to expiration. Like your last 5 days is when it really matters.
It does.
But
yeah. But
until then, it doesn't matter. No. Yeah. Now on the other side, if you're selling options, which this is a little bit more of an advanced strategy, Theta decay becomes your number one. Delta and Theta become your number one and number two. Your number one and number two Greeks, because that determines when selling, it determines how profitable and how quickly you're going to see that profit. And so if you want to see profit quick when selling, you want a high Theta decay, because what you're doing is you're selling it high up front and then you're buying it back at a discount. So you want it to decay in price so you can get a cheap discount and close that trade. But yeah, that's a completely different strategy, and it's complete reverse of buying options. All right. So Greeks are important. Learn them. Don't be afraid to research them and figure out what they mean and what they're doing, and they'll help you out with those trades. What's next, Cedric?
Okay, well, after you've learned the Greeks, you should be trying to figure out, because I'm pretty sure at this point, as a beginner, you don't know candlesticks. You don't even you don't know price action. You don't know price structure. So I think you should become familiar with candlesticks and candlestick patterns.
Let's take it back a little bit and go even closer into like the very, very basics. What is an option contract anyways?
Oh yeah. That's a good one. So yeah, okay. So terminology then. Let's
Yeah,
start
let's
there.
just start at the
Terminology.
very basics. If you had to
Yeah.
explain what an option contract is, what would you say?
Well, a contract, one contract. Let's just say, um, let's say this stock, blah blah blah, is trading at $100, and you buy 10 shares. You got $1,000. You buy 10 shares. Now this stock, this it goes up $1, right? You make what, $10?
Sure.
Okay. Now you just benefited from the price of that stock moving, but you had to buy the shares to benefit from it. With options, well, especially when you're going long, you are buying the you have the option to buy those shares. But you don't have the obligation.
Well,
You have the option, but not
let's take it down even further than that. An option contract is simply that. It's a contract between two people. And based on what side of that contract you're on, you're either buying or selling the option. And what it is it's worth 100 shares, but you don't have to have the shares backing it in order to buy and sell that contract. So
right.
you have two types of option contracts. You have a call option contract and a put option contract. Now from that, you have the option to either buy a put, sell a put, buy a call, or sell a call. Now each of these has a different type of utility. They're there to provide hedging or protection for your shares. They're there to provide.
And there's another person on the other side of those positions. Like I didn't know that at first.
Yes, the contract is between two people every single time.
Yeah.
But there's several reasons. They're there for hedging, protecting your shares. They're there to provide additional leverage, make your money go further in a trade. And they're there to offer a derivative exposure to the underlying. And so you can use them to, say, get a cheaper entry on, if you're buying shares, you can use an option to get a cheaper entry than the actual share price. And vice versa, if the option price decreases, you can exercise or assign that option in order to sell your shares at a higher price. But basically, it's a contract between two people. Each contract is worth 100 shares of the market.
So, like, hear me out. Now, the reason I brought that up first is because, you buying 10 shares, it costs $100. You got $1,000. You can only get 10 shares. Well, with options, you're getting. Remember, one contract is worth 100 shares. You can get it. You can put with that same amount of money. You can control more shares, essentially, right? Without even owning them, you can control more shares.
Let's take a real example of this. Let's take a realistic look at this. For example, Tesla. It's currently trading at $299, so about $300 per share.
Whoa,
the options,
it
is at $299. The option contracts are about $1,000 right at the money. So what that means is that if you had $1,000, you could buy 3 shares. But if you have $1,000 and you purchased an option contract, you could control 100 shares with the same amount of money. That's 97 more shares than what you could buy with just the cash.
Right. And when it moves, your money moves exponentially versus just you owning the share.
That's true. And how we know how much it's going to move for each dollar is your delta. So if it goes up from $2.99 to $300, it will increase by $50 or 0.50. A 0.50 delta at the money. So that means,
guys, if you have any questions, feel free to ask them, because
yes,
I know
please.
This shit is not simple.
It is not. It does take a little bit of time, but it definitely will help you if you start learning it and understanding it. So if Tesla goes from $2.99 to $300 on the underlying chart right here, then that option contract that you bought for $1,000 will then become worth $1,050. So you will make about at the money, you will make half of what you would have made if you had 100 shares. But remember, you could only afford 3 shares. So you would have made
Right.
$3 versus $50 for every dollar move.
Right.
And that's the power of leveraging your buying power with options.
Let's say you own Apple. No, what is this? Tesla. Let's say
Tesla.
you own Tesla, and you own this is the other side of it. You own
Sure.
100 shares already. You own even if you only got 10, you own shares of Tesla, and today they're down. They're down 15%.
Let's say you bought your shares at $200. Well, let's say you bought them at $298. Okay. Actually, let's say you bought them at $281.85. Okay, you bought your shares there. You have 100 shares now. Tesla tanks down and goes below 281. If you have a put option, if you bought a put, you are holding a contract that allows you to sell your shares at a strike price. So, in this case, say we bought a $300 put. It cost us when Tesla was way up here. It cost us $100.
But look though, y'all, when you're doing this, you're doing it to hedge your portfolio, to keep your portfolio from taking so much of a loss. The stock is down, so you buy puts on it. Right? You buying puts to have, because you really don't want the price of this shit to come down because you own so many shares of it. But when you leverage it by buying a put, now
and then here's
2 ways.
Here's 2 ways that you make money from it going down. By buying a put, you can sell your shares at the strike price. So say your put was for $290. Yeah, it's trading at $281 now, but you can sell your shares for higher than what it's trading at because you entered into agreement before it was trading at that level.
Is that called exercising the contract?
Well, it's called yes, you exercise it, but it's called assignment, put assignment.
Okay.
And so the other person, that contract was an agreement that, hey, if the market tanks, I will buy 100 of your shares at $290. And you don't have to worry because it's facilitated by your broker. It's facilitated by OCC, and you will receive money for those two. If you assign it, you will lose 100 shares, and you will receive money at that strike price. So 290 times 100. You will receive that money into your brokerage account. The other way is you can buy a further out of the money put, and as price falls, you say you don't want to sell your shares, so you don't exercise. You wait, and as the price gets closer, it will increase in value, and then you can sell that for a profit, and it offsets a loss on your shares. So there's multiple ways to hedge with puts like that.
Hell yeah. And next up is expiration dates.
Yes. And I think we also need to explain kind of the strike price. I know we've kind of glossed over it a little bit and mentioned but we haven't really defined it.
In the money and out of the money, because that's now that is confusing. I understand why people are confused with in the money or out of the money at first, but once you understand it, you will never be confused again.
Oh yeah, for sure. So yeah, we already talk about expiration date? That's the date. Okay.
Not really.
Go ahead then.
So whenever you're dealing with options, it's not so much as buying the underlying stock. It's solely for options, right? When you're dealing with options, they come with the expiration date, and you want to hit what you want to go in the direction that you expecting it to go in before it gets to that expiration date. So if I think Apple is going to go to $300 in the next 5 days, I really want to buy expiration date that expires. I want to buy a contract that expires in the next 10 days to give me more time, because if it does happen on that last day, like Chad was talking about with the theta, it'll lose intrinsic, or it'll lose value because it's so close to the expiration date. Nobody else can buy that contract from you and benefit from it. Remember, a contract is between you and another person. So you got to sell that contract on the expiration date. It will expire worthless, or it'll expire in the money, right? It'll expire is what I'm really wanting you to pay attention to. Is it has an expiration date. You enter a call or a put or any strategy, there's a time limit on it, and you want to buy yourself time. That's what you're paying for. It's going to cost you a little more, but you're paying for time. Otherwise, that's why they make the zero DTEs cheaper than everything. Now you can interject now, Chad, because I really want to hear what you got to say about it.
So basically, the market prices these. So once again, these contracts are a business contract between two people. Both sides are going to do what's most favorable for them. That's just how contracts work. So your seller is going to set your price, but then different catalysts in the market is going to determine kind of how that price changes, because it's going to dynamically change to make sure that both sides are getting a fair deal. And so generally you can expect that option prices are accurate and good most of the time. Every once in a while a piece of news will come and the option prices before that news hits will be mispriced, and you can sometimes take advantage of that. But generally they're going to be priced fairly and correctly. So as he was saying, as you get closer to expiration, you have more theta decay, you have more risk, and so because of that, those option prices become cheaper and cheaper and cheaper until they expire, worthless. If you go out further in time and there's more time for expiration, once again, you do pay for that time. They are way more expensive. But you also
why let's stop there, because I don't want y'all cheap ass to not get it because it's more expensive. Y'all got to understand that it is more expensive because it is more likely to happen.
It is more expensive because there's less risk. So there's two sides to it. As you get closer to zero DTE, the riskier options are going to be
more appealing, more attractive.
More attractive and more appealing, but they're also going to be a whole lot less likely to happen. Like, for instance, this has a 22% chance of it hitting 320 today. It could happen, but most likely it's not going to.
Off of y'all looking at them options, and they make them options super sexy to you because they're making a lot of money knowing that it's not going to hit that. Meanwhile, Chad and Morgan is on the other side of that fucking trade with a calendar spread.
Oh yeah, our credit spread. So oftentimes that means you can take a look at options and see which ones are more likely to happen just by looking at their price. I wouldn't take that as, you don't buy the most expensive option, but generally where your fair value comes into play is around a 30 delta, 30 days out. That's probably going to be the cheapest, but the highest probability of change between then and there. So if you're bullish on something,
don't let him just run by that. I'm gonna repeat that. Y'all need to write that shit down or something. I don't know, but say it again for the people in the back, Chad.
All right. So your most cost-effective options, so the ones that are going to be cheaper but still have enough probability of actually occurring, are going to be 30 delta between 30 to 45 days out.
So not the 2 weeks, not the expiration date needs to be about a month out or a little bit over a month.
30 to 30, I think it's 32 to 45 if we want to get like very specific, but between 30 to 45 days out is when you want to buy, and between 15 to 18, usually around 18 days out, you want to sell.
This is a mini cure for FOMO. It will take away not FOMO but FUD. You know what I'm saying? FUD. What is FUD, Chad?
I'm not sure actually.
Well, FUD in the market is the first. It's an acronym.
Yeah.
Okay.
Fear.
So, yeah.
Fear of or fear.
Yeah, fear, uncertainty, and doubt.
Okay. Yeah. Okay. I see what you mean.
It clears the fear and uncertainty and doubt because it gives you time. It buys you time. If the price isn't where I expect it to be today, I got 35 more days. I got 30 more days. If it's not there in a week, I got 3 more weeks. Like you got time.
Let me tell you guys a secret. You can make a career by buying in a bull market 30 days out at the 30 delta and selling it halfway. Don't even got to look at the price. In a bull market, most things are going up.
Hold on, Chad, because JB in there, and JB listening. Me and her was talking about this the other day. we don't realize because she realizes that people are saying that this is a hard market to trade in, and she was like, "What do they mean? Are you telling me this is not what the market normally looks like?"
Oh, yeah.
So explain to the people. I'm sorry for interjecting and cutting
No,
you
no,
off. I
you're
just
good. You're
want you to
good.
put I want you to put emphasis on what type of what does a bull market look like and what to
Okay.
do in it.
Yeah. So the
And when
market.
was the last time we had one too?
Sure. I'll go into all of that. So yeah, markets are interesting because they move in waves. They move based. The market is so simple. Once you finally realize that the market is just people buying and selling, everything just starts to click for you. The market runs off of fear and greed. If people are greedy, people buy more. So the market goes into what's called a bull run, where over time you see mostly increases on stocks, a lot of buying, things get overbought way too much, but the market is generally going up. Now the opposite occurs in a bear market, and it's not a perfect opposite. It doesn't just go down in a bear market. Generally what happens in a bear market is that it trades sideways, and you have long periods of sell-off, or short hard sell-offs followed by short reversals or gains. So it's caused by fear and greed. It's more volatile in those bear markets. But generally, in a bull market, it's easy to make money. It's super easy. You could just buy a 30 delta 30 days out and close it on the 15-day. So hold it for 15 days and then sell it, and you'll probably be up. And you can just keep doing that as long as you're in a bull market. In a bear market, you no longer have the ability to just kind of fire and forget. That's when it becomes extremely important to understand technical analysis, certain levels of support and resistance, and supply and demand. And then you have to time your entries, you have to time your trades, and you have to follow your trades very carefully. That's kind of what we're in right now. We're in a period. We're not. I mean, we have been in a bear market. We haven't really been in a terrible bear market, but we have been in a decently bearish market. There's been a lot of fear, which increases volatility, meaning we have wide price swings up and down. That actually gives us a lot of opportunity to make a lot of money on both calls and puts, but we do have to time the entries way better and be way more smarter in our trades in this time. So our last bull market was probably last year. We had a long run. We hit an all-time high on SPY, which is a ETF that considers the top 500 companies, called the S&P 500, top 500 U.S. companies. And yeah, we hit an all-time high. Things were looking great. Then we had a downturn. Now we're kind of in this recovery period. I personally believe we've started our bull run. A lot of people are agreeing that around April 7th is when we kind of hit that bottom, and we started making a run back up. And if you look at the charts here, you can see that we've been generally in a let's look year to date. We've generally been in a bullish pattern since right here around the 7th of April. We hit the low, and then we've been in a strong upward trend since then. Here's our all-time high. We're almost right back up to our all-time high. So as we get closer to this all-time high and as we pass it, you're going to see the market just rocket off. People are just going to be super excited. They're going to be buying. And at a certain point, the market will tip. Things will begin to slide, and we'll start to see a correction again. That's when you have to time and be smart with your trades. But right now, for the most part, any stable company, you're good with making money for now. 30 days out, 30 to 45 days, 30 delta and 30 to 45 days expiration, and you will be A-okay. Now, that being said, we still recommend, we recommend that you time your entries in a bull market as well. That just gives you a little extra profit, but you don't have to be as good. It's easy to make money in a bull market. Cedric,
All right, yeah.
thoughts? Did I miss
And I
anything?
had a package. Hey, I had to go sign for a package. Sorry. What did I miss? Did you explain it
So
to
I
him?
talked about bull markets, talked about bear markets, talked about how it's easy to make money the market is driven off of, the market is made of people. The market changes and swings up and down based on fear and greed. In a bull market, it's easy to make money, just go out and up. In a bear market, it's a lot harder because you get a lot more opportunities, but it's very much volatile or trades sideways. And so you have to time your entries and be a better trader during those bear markets.
They won't say it, but I've paid attention since January to now. I've paid close attention to the year to date, and the Bulls have had control
Since April 7th. That's what I actually mentioned. This is our most recent bull run from April 7th till now is our most recent one.
Yeah, from April. Yeah, but that's what I meant. But from January to April, the Bears.
Yeah, that was very
And
bearish.
yes, and if you pay attention to the retracements or the corrections, basically when it goes down, pay attention to how much it comes back up, or when it goes up, pay attention to how much it goes back down, because it does
Sure.
go up and down, but how much?
Another really easy way to see if you're in a bear, the Heiken Ashi candles. You click on that, it averages them out, and you can always see super easy. Bear, bull, bear, bull, bear, bull, bear, bull, bear, bull.
Oh, because that's the one where they take all the candlesticks right here and make them red, and then take all of them and make them green. So it's
Yeah,
like
it just basically averages it and closes the gaps and it averages the prices, like the opening and closing prices.
I use that though, because I really want. I'm curious. I saw that and I'm like, wow, how is this helpful?
I like it because you can read this almost like I wouldn't use it for everything, but like I said, you can identify trends very easily. For instance, let's go to like the 1 minute chart today. All right, so this is what you're seeing on the 1 minute chart today. Let me make this a little bit bigger. All right, now let's say you're scalping. I've been in the market enough, like it's pretty easy to see these trends. But say you're newer to the market, you can use these candles to even help you identify those trends even better. And it's just another way of looking at the data. And you'll notice you can actually use these as like candlestick analysis. You can say, hey, this is a sell period. It's a descending. All right, I sell. All right, so now we have dojis. I'm going to buy back in.
Oh shit, Chad!
And you can use that to scalp stuff.
Hold on. I ain't know it worked like that, because when I look at it, it's red and green, red and green. I'm like, okay, this isn't fucking helping me, and he's just. But
Yeah,
it is. I see what you're saying. So when the volume slows down and the momentum slows down, you can see it clear on the high Shiniki or whatever.
Or the Heikenashi or something like that. Heikenashi.
Hoshitashi. I'm gonna call it everything but what it's really called.
I understand. Yeah. But basically, you can see, and it does. It's not perfect, and it's not. Do I recommend trading off of it all the time? Probably not. But you can use it as another type of indicator to see, hey, our momentum's slowing, and it can offer a better look at when reversals might happen.
Right.
So like this one is so much more clear. If you say, hey, reversals happen at a certain doji, you turn to this one, and it'll be that doji right there at those reversals.
So as far as the bull run and the bull market or the bull run, right? We have been in a giant consolidation.
Yes.
We don't see it because we're not zoomed out.
That brings me back to my favorite saying: "When in doubt, zoom out."
Yeah.
Because what we're seeing is like, it's a $5 move up and down every single day. And it kind of seems sideways, but if you zoom out, you notice we've been going up this entire time. It's just been very little baby steps, but we've been going up. And I'll prove that to you. Here's our year to date. And let me put this to the normal candles again. There's our year to date. Since April 7th, we have been in a steady upwards climb. Yes, there's been down periods, but we're going up every single day.
Yeah, we're almost back to where we were.
Yeah. We're $13. $13 from an all-time high.
Now I want to go into that data. That data tells me a lot, right? What does it tell me? What does it tell me? It tells me that
honestly, this was an opportunity. You got to take advantage of these opportunities when they drop down like that. Though it tells me that we're about to, if we're that close to almost being back to where we were in January, it tells me that since people are so short sighted and they can't see ahead, it would have been so smart to go ahead and enter a trade for it to go back to where it came from, right there where he got the mouse at. That now I know that's a sniper entry. That is a crazy entry, but somebody was like, "Oh, I know it's going back up to 6. I know it's going back up, but when?
Well,
How soon? Back test when was it at the all-time high versus that all-time low,
here
Chad? From
let, let
there
me
to
let me
January.
let me go and just talk about when I started calling it that we were back into it. If you know me, I like to trade on trends. So let me just show you what that looks like. We hit this bottom level. We had a strong increase in price. We came back and we made a new bottom. At this new bottom, as soon as we had this green candle, I began telling everyone, hey, look, we found our bottom.
What
We
day
bounced.
is that, Chad?
That would have been April 21st. We bounced and we're making a run for highs now because we had made a very strong higher low. Now, as we trade up, we hit this level, we came back down, we made a very strong bottoms on these trend lines the whole time we've been trading up, bouncing off this trend line. And I've been telling people, hey, buy out, buy high out of the money for that previous high because we're going there. And some people did, some people didn't. But that's the longer term trend. And now we're starting to see a little bit of a lessening of that steepness of the trend. But we're still very much bouncing off that trend line. We're still very much in a bullish level. We are starting to see a little bit of a top here on the day charts. So I assume we're going to have a red day coming up pretty soon. We'll probably bounce off this trend line again. If not, we'll continue our analysis at that point. And go based off where those new candles are. But for now, we are still very much in a bullish trend, and we're doing great. I mean, had you bought 600 calls from down here for, say, this was 2 months, if you had gone and bought this right here, let's see, if you had bought, say, September calls, which is something that I recommended to a lot of people, your September calls would be worth about $2,000 a piece. Back when we were trading at that level, they would have been out of the money by at least, let's see, 488 to 600. So they've been out of the money by almost $200. So you probably could have bought them at about, $20. They're now worth $2,000.
You know what, Chad? I think and I'm not, and I know you saying that, he's saying that, but that means that when Chad say some shit, don't think he bullshitting. Now you see how far back he was letting people know when to do it, right? So look at this is in this Discord. I want to say the same. I want to make the same point real quick, Chad. If y'all
Okay.
can look at my screen for a quick second. But Chad, tell me what's the bottom? What is the bottom right now on that chart that you're looking at? In
Right
April,
now on
right?
this chart, let's
No,
actually.
yeah, not right
okay.
now. Back in
488.
April.
488. So
What date is that?
April 7th.
April 7th. So April the 4th. In my now you can look at my screen real quick.
All right,
Now
I do want to
I
pull
was
that up.
telling them, I'm not buying no calls until this shit is over with. This is April the 4th. Unless the call is for next year or later this year, ain't no telling when this shit gonna go in the opposite direction. I told him this is April the 4th. You said that's April the 8th?
April 7th.
Okay. Like I said, in 2022, if you wasn't buying within that time, the next month it went all back up. It went all the way back up. I was then back testing, looking at other times in history, the price did exactly what it's doing now, right? So I'm gonna go to that exact date.
April 7th.
April 7th. Okay, hold on. I'm showing SPY. I'm like, wake the fuck up. April the 4th. I'm seeing this shit. I'm like 3-month chart, 611 high, 505 support. Let's back test further. Going back further, since it broke previous support of 505, I'm looking for it to go to the 490s. I'm waiting
That
on
was
this.
3 days before 498.
Come on. Like, look, now, hold on. I'm finna go to the exact date though, because they was sleeping on me hard in this Discord back then, especially this guy Orange. I miss him though. This was my biggest op,
Yeah.
worst fucking app. He went against everything I said in this server. Like, if I came with a technical analysis, he's like, nah, you
Right there.
wrong.
All right,
But
4-6.
put some money on Spy going up, and if it does, you will get the title Mr. Big Balls, whatever the fuck that means. I just told him that though. But here, what else? Where is it at?
Probably
I'm just
sniper.
saying I can't make too many mistakes. I'm looking for it because I called the bottom. I realized that it was going back up. I've never seen futures move this much. Futures was going fucking crazy at the time. Let me see. Where is it at? I'm looking for a specific date, you guys.
All right, here we are, 4-7.
Okay. So this is what I guessed, but it has to tank. You want to stream, blah, blah, blah. Spy ripped, it's back low, and this is my fault, you guys, blah, blah, blah. You need to be more confident. Hold on.
All right, right there. Scroll back up. There you are talking about VIX. Initially said calls, VIX slower. Okay,
Yeah, hold on,
no,
it's
that's
coming.
not it.
It's around this time. I zoom out every other now and
So
then.
that's the
then I
next
just
day?
start. Yeah. So I'm somewhere in this month. I'm letting them know, like, listen. And it was a big announcement for me too, because I realized that the light bulb lit up over my head, and I was just, y'all know how I get real motivational sometimes, and I went ahead and let everybody know, like, look, this is the bottom. I tried to type it in, but I used the word bottom too much, so it wouldn't really show.
Yeah, for sure.
Let's see. But I'm close. I promise. I promise. I'm close. Boys and girls, let's break down this real simple for you. Oh, that was me telling them about good till canceled.
Yeah,
They
that's
were
good information.
confused about that one. Okay, yeah, he was misbehaving. I'm like, chill. I don't want to put you in timeout again because he was crazy. Yeah. That guy's crazy. All right, let me see. Here it is. Is the part though asks, did we just hit the floor or are we still dropping? He asked a very great question.
Yeah.
Because at that point, we were on our way back up.
Yeah.
VIX was fucking 44. We didn't realize it was history. That shit was history.
That was making history. That was crazy.
Shit. Yeah. So let me see. Where is it at? Blah blah blah. What is it? Oh yeah, this was crazy.
That's terrible.
Yeah. All right.
We're gonna have to blur that on the YouTube.
Yeah, I'm sorry.
I have
no,
a
we'll be fine.
for Chad, really quick.
Yes.
Go ahead.
Chad. So the 30 delta, is that like a definite? Like it should be, the delta should be at 30 if you're trying to do a swing trade.
No, definitely it's not. It's not a definite. Personally, I like to time my strike price based on my price target. So where do I think the underlying is going? For instance, on a $10 stock, I think it's going to 20. I might do like a 15 or a 20 strike, and I'm not even going to look at the delta. Now, if I'm just trading based on delta alone, then delta 30 is going to be the best thing to do. And I can go into more detail if you need. Does that answer the question, or the 30 delta is kind of just like a fire and forget?
Okay.
30 delta, 30 days out, close at 15.
Okay.
Because you're not at that point, you're not looking for a certain price target. Say the 30 delta is a $20 strike price, and you're thinking it's going to hit 15. You'll make money as it gets closer, but you're closing it halfway because you don't think it's going all the way to that 30 delta. On a high conviction trade where you know or you have a feeling where the price is going, then you can hit a further out of the money or a lower delta contract, like a 10 delta or 20 delta. And if the price hits that, then of course as it gets closer, the delta increases and the price increases.
Okay. Yeah, that makes sense. Thank you.
Yeah. All right. I don't think it's too important finding that. I know we did.
Oh, yeah, no, y'all can go ahead. Y'all can go ahead.
We did the same thing. I actually released a couple of. I generally will release an analysis. Let me see if I can find the analysis. Let's see.
I can't believe
More likely to find a crash out before you're gonna find this said.
Yeah. Okay. Ideas. Core's prediction. Spy calls. I said this back in around May. We had just bounced. Look at the prediction, and up till now, we're still in the money on this. But this was
Here it
another
is. I'm
opportunity
sorry,
to
I'm
enter
waiting.
on that. You
I
found
didn't
it?
do all that for nothing. I'm done.
All right.
Here it is.
Let's
Here
find
it
it.
is. It was April the 23rd. And because we was asking about the bottom, and I'm like, look, we hit the bottom already, but it was clear as day though. I mean, people still was expecting this shit to go down further by the end.
Yeah, I see that right
But
here.
even then in April, that was, even anywhere around that week was like your opportunity to get back in before it to go back up. But I'm just trying to. I really was only saying that to show that you buy yourself time. Like if somebody had said, I think it's gonna be back to 600 by the 600 calls were cheap back then, right?
Oh yeah, absolutely.
Right. That's all I wanted to say. All right, I'm done. I just wanted to put emphasis on that because we don't know once it passes this level, how high can it go? What we don't know.
650. We can use
650.
Fibonacci levels to determine kind of an area, and I'm looking at between 625 and 650. So write that down. We're right at 600 right now, but I'm looking at 625 to 650 by the end of the year, probably sometime in July or August, before cooling off around September. Barring
625
news.
by August. 625 by August.
Something like that, yeah. I personally think it could go up to 650 though.
But 625 is gonna print if it do go to 650.
Potentially.
Yeah.
So here's a look at a trend line. Here's our second base. That's when I knew we had found the bottom. When we had that second bounce off the trend line, I was pretty confident. Hey, we're here at the bottom. You go back in time, you notice that, oh, look at this. This is another level of support back here. It's another level of support back here. This is a strong level of support. We broke through it. Now we're back at that level, and I could tell, hey, we're coming out of this. I made my first predictions around here, and every time it touches the trend line, I've been telling people, buy in. We're right at the low point now. Buy in. And we've been aiming for that previous high. We talked about Fibonacci levels.
Somebody might be like, well, how do I know? How do I know if it hit the bottom or not? Well, y'all better practice paying attention to higher highs and lower lows.
Well, I think it was McLoof made the comment about learning to find levels of support and resistance. And that is a really, really underrated skill. But if you can look at previous levels of support and resistance, you can go back in time and say, hey, when did it bounce last time? And you can put a little horizontal line there and say it bounced right there. Oh, well, look, it bounced there again. Or, hey, it bounced right here. It bounced right here. Oh, hey, look, it bounced right here too. Or you can go back right here. It bounced here. Oh, it bounced here. And it bounced right here as well. And you can just keep on doing this.
It did the same thing in 2021 at the same level.
Here we had a little bit of a resistance at this point. Let's go right here. Oh, look, it bounced right here again. And you can just keep doing this for historical levels, and not all of them are going to be accurate, but look, we got another bounce right here. What do you think the chances are that we come back down and bounce right there?
Y'all know one of why it's bouncing is these numbers are psychological fucking numbers.
Yes. Especially
It's
more
all,
so
human behavior.
Yeah. And once again, the market is made up of people buying and selling based on fear and greed. Now, another way to tell, like, hey, we don't have any more highs after this level, how do we know how far we can go? Once again, we take these numbers, which are called Fibonacci levels, and these are natural numbers that are psychological numbers for humans. They're found in nature. They're high probability psychological levels. And so what we can see is around certain levels, we have bounces. And if we can take the previous high, go down to our low, then that gives us our expected next high, which in this case is going to be right around this level, which is about 646.64. Now let's say we take this trend line, which this is our current trend. Let's extend it out in time and see when this crosses this price level. That's about July 2nd, 2025. We want to give it a little more extra room. We could say by August, we're probably going to hit that level if we continue trading on this trend. So for me to show you this and say, hey, I think that we'll hit 650 by August, that's not really that far, or not that big of an out there statement. If you take into consideration these historical levels, the Fibonacci levels, and then the current trend that we're trading on. Would you guys agree to that or no?
No, I agree. I agree. And then there's two. I also would like, so a person would wonder, okay, well, Chad, how do you determine how far out the expiration date should be? I have a method for figuring that out, but I want to know. I'm gonna ask you first. What do you?
Well,
do?
yeah. Look at this trend line. If we're trading on this trend, and we continue to hold to this trend, I mean, I personally take the trend line. This is our average direction and time. That's what this trend line is.
Right.
Up is our direction, and then out is our average time. So we take that and we go up to our price level, and this is where it crosses. So by 2nd of July 2025, or if we really want to be much more accurate, we can take this bottom and we can go to our most recent bottom here, and we
Basically,
can say, okay,
use the chart.
it crosses right here. So maybe this will get more steep, maybe it'll get less steep, but I mean, it's going to be somewhere in this area when we cross this level. So that's July to August.
You college professional level with this shit. And I'm not saying that everybody can't get comprehend what he's saying. I just know this. I have to break it down for the people that don't understand what you mean. In school, they was trying to teach us, if y'all wasn't paying attention, like I wasn't, they was trying to tell you about the XY axis on the chart.
Yes.
You want to use this chart to help you figure out when the price will get there in relation with the trend line, because that's literally your roadmap. So now we know that if it continues to go along this trend, the dates are at the bottom. So though your expiration dates are at the bottom.
All right, here's what we have.
Go ahead.
This right here is if we want to take it back to our middle school level, we're plotting a line on a graph. This is our top right quadrant. We have price on the up, time on the left, on the horizontal.
Right. So
price and time.
You're looking for a strike price and an expiration date, right? So keep that in mind when you're using the chart. Your strike price is on the right, the expiration date's on the bottom. When you're looking at a chart, look at it that way. It'll help you.
So what we're going to do is we're going to find our price level. Where do we want it to go? Let's say 640 for this example. And we're going to plot a point there. In this case, I'm just going to do a line. So, that's too low. Let's go back up to 640. There we go.
Maybe it's my phone, but your screen is frozen on my screen. I don't see nothing but the spy chart for some reason.
Mine too. Screen is
okay,
frozen.
Let me make sure that it is not doing that, because that's not cool.
Yeah, it's been a minute.
Okay, well, I will refresh it for you guys real quick. Is that better?
There we go. Yep.
Cool. All right, so here we go. Price and time. I'm plotting a line right here at our price. This is our price level, 640. It was 646 to 650, but we're putting it right there for ease. All right. We have that. So I'm going to plot a trend line based on the current price's trend. So I'm going to find the bottom price, our 0, 0 level right here. And where is it at currently? Right here. That is our trend line. Now we can go forward in time to where it crosses this level to have an understanding of what expiration date.
And what strike price.
Yep.
Now,
if we have that,
go back, slow down. Go back right there where the mouse was at to the point where it's about to be at that space and time.
Okay, let me show you this too. If we take Fibonacci levels from the previous high to the current low, this is going to tell us the next level. So this is our previous level, this is our next level, around 642. So that's why we put that price level at the 642 level, or at the 640
That
level.
was a Fibonacci retracement tool.
Yes, the Fibonacci levels.
Y'all got that on y'all chart too. It ain't hard to use. You just, like he said,
boom.
You start from one side to the other side.
The price is at 0, 0, so boom. We can either go to the most recent trend that would give us a shorter forecast. But when you notice we cross our candles, so we go out a little bit more, go out a little more. We don't want to cross candles, okay? We aren't crossing candles here, so that's a good realistic time frame for now. If we want to be even more accurate, now you can take this level and you can find the most recent low, and that gives us a little bit further forecasts. But still, it's between July 2nd and July 11th. So my forecast of between July to August gives us a big range where we could potentially hit this level right here. Now I'm going to show you guys something else. If we go here, we go out to July, or let's go out to August 15th to be a little safer. Let's go to those levels. $650, $100. If we hit that level, that option contract, let's say we hit it with 5 days,
Slow down,
10
Chad.
days.
Slow down. Wait a minute. Don't just zoom past this shit, because this is important. Like, are you saying that for right now to buy that contract is $100?
Yeah, $100 for a 650 contract.
Right, that expires when?
August 15th, 2025, right here.
Now, what we don't understand is he's about to tell us how much it's going to be worth once it gets there. But I want y'all to understand that that's cheap compared, because they making it 100 because they see this too. They see it too.
Sure. So yeah, at $100, which I guarantee you, 5 days ago this wasn't $100, or further out it was probably like $5.
Might have been 50.
Oh yeah.
40.
But right now it's $100. Now let's say we hit it by we hit it. See, it's the 15th. Let's say 67 days out. We hit it within. Our forecast was July 11th was the latest, so we hit it after 32 days. So we can take 67 minus 32, and that gives us 35. So if we go to the $35 or the 35-day out contracts, which is actually going to be in between these two, and take a look at the money prices, that $100 contract will most likely be around $1,000
for each one. For
for
those
each
that
contract.
only bought one contract, that's how much you're gonna have for that one. But if you bought 10, if you bought 20, and then on top of that, it's not a gamble, because you just used, I counted, they used 4 different things to determine.
Well, and we can even go further than that.
In the expiration date, and he's talking about going further than that.
Now let's look at this on a price curve. Let's say we're currently here. We said it was a 650 contract, currently trading at $100, right? SPY is currently trading at 600. So if SPY, refresh this, if SPY hits this level, let's see. We're going to have to zoom out on this. If
By
SPY,
the way, SPY could hit that level before that date. Absolutely.
But let's say it hits it within 30 days. Let's say halfway there, it hits 650. You've made 1,200% return at right around, so about 1,000% return right around 650. In dollar amount, that's going to be about $1,000. So that's just to show you that I'm doing the calculation in my head, yes, but I'm not just making these numbers up. And now say we get there by July 2nd. 650 is going to be right here. That's $1,174 from a $104 contract.
Yeah, before y'all get all happy and shit though, just keep in mind that we in a news-driven situation with Trump. I don't know what the fuck going on for real, but they can decide to tank it again before we see that shit. Not saying that this is likely to happen, but you got to keep it in mind and be prepared for it. But stop losses keep you from worrying about that type of shit. Risk management keeps me from worrying about that type of shit. I stay optimistic because I got a plan for if it doesn't go in my direction.
Now watch this. I'm going to show you guys some additional indicators here to take a look at.
I'm sorry for cursing. I keep forgetting this. You putting this on YouTube, so they curse on YouTube too.
We have our MACD right here, buy cycle. Now we're in a sell cycle. We're about to cross over into a buy cycle again. We are a little high on the RSI, so we could see a slight dip before we push up. But if you look at the weekly chart, this one gets really interesting. we're not hardly at an overbought area yet. We're in a bull or a buy cycle, and we've got time. We've got time here. And so what this means is we're bouncing off this trend line. You could buy in for that level, and you could probably make a cool, $900, $1,000. And even if we don't hit that level, the 650 level or the 640 level, if we hit, let's go back and look. I'm not even going to try to pretend or do the calculations. We'll just look at the actual prices. Say we hit 612 or 613, which is our previous level. We're still making money. Not as much, but we're making money.
Yeah.
$150. It ain't terrible. Now, as that goes in time, of course, it'll get smaller and smaller.
Tomorrow, when we look at, tomorrow when we look at that same option, it won't be the same price. So,
guaranteed.
I want you to know that this is not financial advice, but I want you to keep in mind that if you was to enter this call or enter this position, because that's also, how would you play that since you know the range you about to trade in?
How I would play that is this right here. I'm choosing an entry based off of a bounce on the trend line. That's number one for my strategy. I wait for the bounce on this trend line and a bullish crossover here.
I want to know all the ways that somebody can play it though, because I'm looking at it like even if you didn't do a regular call, like you could do a strangle, and I mean shit, especially if you can afford one that's within a small ass range and it trades outside of that range.
Go to this way if you want to do that. Go to this website, optionstrat.com. Hit optimize, and you're going to go to SPY, and you're going to say target price of $640. And you're going to give them an expiration date, and here's all the ways you could play this.
That's what I was. Okay, yeah. All right, cool.
So yeah, let me throw this into the chat too. This is super helpful.
Whose website is that?
It's just a free option website. It's great. I just threw it in general chat.
Trade or something?
This right here?
Yeah, is that from who is it? Tasty?
It's just called Option Strat. Optionstrat.com. I just threw a link in the Discord. It's free. They do have a paid version. You don't need it. The free version is plenty good enough. But yeah,
I think that's a very genius idea.
Hit your target price. Put your budget in. Say I have a $2,000 account. This is what I can do. Right. This is a level 1 account. These are level 3 accounts.
All right, yeah.
That's my expiration.
If y'all enter that position, just hear me out. Make sure you prepare for it if it don't go in that direction. If it does, then happy day, happy day. But if it don't, you still don't give a fuck because you ready to get out the trade. Other than that, we just gave you a hell of an analysis of the reason why.
Yeah. So if we were to enter,
telling us how you would play it though.
Well, yeah. If we were to enter the trade, we want to look for a bounce. This was our most recent bounce. We're going to set a price target up here at our level, which was about 640. Oops, I keep putting it at the wrong level. 640. So that's our level. We're going to take the trade out to, I think it was August 15th, so about right there. And we're going to take our target all the way up to that level. And then our stop loss is just going to be our previous support. So right there. Now we have a 1 to 3 risk reward. And yeah, it's a decent trade. It's not my best trade, but it's definitely one that you can take advantage of.
1 to 3.
Yeah, if you want to wait
3 to 9, do 3 to 9, do 3 to 9.
Well, let's do this though. If you want to wait for the next bounce, it is going to be a little shorter. You would just take it to your previous resistance level, and that's going to be a slightly better. It's going to be a 1 to 5, but it's going to be a similar entry. And basically, all you do is every day you check this, and you would see how the price is.
Show me a little more risk though. Ride a roller coaster real. Show me a bigger stop loss.
I mean, why would you want that though?
No, I'm talking about somebody who can afford it. They tolerance is there because I got some people in here who don't care. Well, and I'm just trying to show them that
here's
you
the
can
deal.
Care some. You can't
here's
care
the deal
some
though.
Without having to be that way.
Here's the deal. We've got a really strong trend line. We have previous levels of support and resistance. like right here at these levels, like this is a previous level. So like if it breaks through this level here, like your trade is invalidated at that point. So you shouldn't be in it anyways.
I'm gonna tell you why I really think though. This is why I really think why you should do it. Because a million other people got their stop loss right there too. And they see the same thing we see. They gonna set their shit at the same spot you setting your shit at because they looking at the same thing. And then the smart money know that shit too. And what they have been doing is sending out these crazy ass lines that shoot straight down and touch your stop loss.
That's not happening on this though. That's not going to happen on this. That can't happen on a day.
I'm just saying, just in case. I'm just saying, like,
I'll show you. I know, but let me show you why that can't happen on here.
You can't. Yeah, that's cool. But look, especially if I'm sure that it's going in that direction, like this is a good trade. This is a high probability trade, and I'm with you when you say it's not going to happen. But that means my stop loss will never get hit, and I'm happy then. If it'll never happen, then I'm cool. My stop loss won't get hit no ways.
Because I'll tell you why. Because retail traders are not taking this trade. This is what institutions are taking. They're taking longer dated, bigger trades.
Right,
most retail traders are trading like 18 days or less, and so they're doing these short dated calls, and that's when you see the actual stop loss hunting.
Grabs and shit.
Yeah, so stuff like right here, a strong bounce downwards, or say it's going down. All of a sudden it's a peak up and then it continues down. This right here is stop loss hunting, because what's going to happen is people are going to put their stop loss, say at this level right here, boom, they hits their stop loss and then it continues down. That's why we don't.
They'll never get me like that again.
That is why we don't trade the 5 minute or the 1 minute. We only trade the 15 minute or higher time frames. The reasons why that cannot happen on the day chart is because each of these candles is an entire day's worth of volume. No institution can manipulate an entire day's worth of volume. If you see a manipulated looking candle, that's because there was a news event. So a news can change stuff, but usually that's corrected within a day or two. But an institution doesn't have enough money to overcome. Let's see, let me add a volume indicator in real quick.
Yeah, and you know what? And to be honest, I don't care who got the power to. I just don't want my stop loss to be hit, Chad. To be honest with you, so I've been able to stay in trades longer by not I'm not going to say no stop loss, but I'm gonna tolerate a little more because I'm gonna risk more to get more. First of all,
okay, yeah. Well, let's take a look at this real quick though. $595.72 price with 92.44 million volume. If we take our calculator, let's do this. 92.44. All right, so that much times 595. This is the amount of money it would take to manipulate that. That's no one has the ability to manipulate the price that far into that stop loss.
Maybe I'm wording it wrong. I don't care why it would happen. I just don't want it to.
That's why it only happens on shorter time frames. So if you don't trade short time frames like the 1 and the 5 minute, this isn't going to happen to you.
So whenever those things happen for whatever reason, because like look at that candlestick right. My bad, sorry, but I'm just saying,
so on the day.
Yeah, like whenever it drops like that, when you got your stop loss set at where a reasonable stop loss should be at.
Yeah, and that's good on the day time frames.
Yeah, so basically that don't work for day trading. It work for swinging.
This is a swing trade, yeah. If you're day trading this, so this is not a day trade. A day trader is looking for opportunities of volatility. So on a day trader, you're wanting to trade like the 15-minute chart, and I'm going to just delete all of this. You're wanting to trade the 15-minute chart, short time frames. What you're looking for as a day trader is you're looking for opening price. A lot of times people will look for the opening 15-minute range, and this is called an opening range breakout. They look for a strong break out of this opening candle. Once that opening candle is broken, we're going to put it to the body of the candle to give us a little tighter range. It stays within it. Once it breaks out, they wait for the correction. They go short. They follow it down. They exit here. Then they're looking for a return back into that range, so they go long. They hold it. They sell once we hit this level. Then they're going to wait. Okay, we broke out. We're bouncing off of it. They're probably waiting right now to see what happens. If it starts to show that it's going to return back in, like say if we use like an RSI or a MACD, and it says, oh, hey, look, we're about to have another downturn. We're kind of overbought here. They might go short soon and follow that back into the range. So that's what day traders are looking at. This is a super simple strategy called the opening range breakout. You just wait to see what direction it goes, wait for the breakout, and then the continued breakout, and then you just follow it back in, and then wait for it to break out and follow it back in.
Yeah, all right. I'm glad I said that because I'm telling you, man, it's people that's listening, and they're gonna be thankful. I have to break this shit down. I'm doing this for y'all because I understand where you're coming from. Not knowing the difference, like I don't want you to take that strategy that he was showing us and then try to day trade with it.
That's not a day trade.
And this is a strategy that you don't use on the swing side.
For another day trading strategy can be like trend trading for the day. You wait for it to develop a trend. Okay. Once it bounces a second or third time, you enter on that trend in the opposite direction. You let it go down. When it bounces, this is called a simple channel. But basically, this is a little channel. Price is moving together like this. It's bouncing in between these lines, and you're just looking for entries on the top, exits on the bottom for short, entries on the bottom, exits on the top for long. Once it breaks
my new investors, you shouldn't even be trading without using this chart. I know people that trade, Chad, and they just buy and sell. They don't never look at a chart. They just trading their P&L.
Yeah. Once you reach an extreme point, either a swing high or swing low, you can use that point as it starts going the opposite direction and wait for it to come back down. When it makes a new bottom, you put a second trend point there, and then just follow that trend. On the third bounce, usually it's safe and it's a strong trend, so you can go, for instance, long on the third bounce as long as it holds. So then you would go long, and you would just hold this long until it breaks. And then your entry's here, and your exit is wherever it breaks up along this trend line. And that's called a trend trade.
As soon as it go below that line, you can just get out the trade.
Wicks don't matter. It's got to close below it.
Yep.
And here's the cool thing about trend trading. You can have a secondary trend as well, which is your stop loss, which we actually did this the other day. First of all, your very first stop loss is going to be that bottom, because if it's not the bottom, you want to be out of that trade immediately. If it is the bottom, you enter, you use that previous one as your stop loss. Then as you go up, you can either adjust it to be your previous level, because if it's holding that trend, it's not going to hit that level. And this helps you lock in profit. It's basically a manual trailing stop loss. Yep. And it really just eliminates any risk you have. So on this, I probably wouldn't have entered until probably right here. At that point, that's going to be my stop loss right there. This previous level. It's also this level over here. And I'm looking across multiple time frames here. That's a strong level support. So that's my stop loss. And I'm just holding it. If I wanted to find a target, nothing really in the close. So what I want to do is I'm going to take my Fibonacci. I'm going to find the high, find the low, and my target's going to be this level right here. Boom. There's my target now. And this is my trade. I'm waiting for it to continue up until we hit that. I'm trading like a 5-day to expiration contract. And that's how I would day trade. That's my entry. Hold. And then, maybe we see it, maybe we don't. But every time we bounce again, new stop loss goes into place. So right now, this is where my stop loss would be on this trade. I don't know how this is going to play out. What I'll do is I'm going to actually save this, though. Publish my idea.
Is this Among Us? Imposter? Is this the imposter from Among Us?
And we'll see how this plays out in a couple days, or in a couple of hours, I guess. And publish it. I will share the link with you guys. This should be a private one. Copy publication link. All right. And y'all can come back and check this trade later today and see if it plays out. But yeah, that's how I map out my trades. I'll either trend trade or channel trade, and then my swing trades are often pretty similar as well. When I'm day trading though, I'm not looking for an expiration date. I'm just going to use like the 3 or the 5. But yeah, questions?
I mean, shit, when you enter a trade, will you show them like to enter how to enter a trade? Like, will you enter one live?
Let me see. I don't know if I have a trading account right now.
Okay.
Hold
It's
up.
all
Let me
good.
check. Let me check my phone real quick.
No. If y'all stay tuned, subscribe, and we got you in the future. Don't worry.
Because I'm currently in trades like on this right here. I'm in different stuff right now.
Chad, I have a quick question.
Yes.
You know the swing trade that you were talking about with SPY?
Yes.
Can you just show me like where and why you would put your stop loss? Like where and why you would put your
Yeah, absolutely.
stop loss, where you put it?
So when I'm trading swing trading, I'm trading a higher time frame, so I'm using the day candles or the week candles. It's kind of similar to that trade we just mapped out, but my first thing is I'm looking for the first, so let's pretend none of this has happened yet. I'm looking for the first higher low. So a higher low is whenever you have a deep low, a strong correction, it comes back down, but it stops at a higher low. So this one is lower, this low over here, and this low over here, this one is the higher low, because this one is lower. So we bounce. You could enter there on the higher time frames as long as it shows strong volume and a continued uptrend, so you'd probably enter on that candle. If we entered on that candle, your stop loss is going to be your previous low, and you're going to set a target at a previous high. So you could set, it doesn't really matter where, but you could set your price target here. You could set your price target here. Okay? Now you're going to follow this trend line and see how long of an expiration you need before you hit these levels. I would have probably chosen like a end of May, beginning of June for this one, because this crosses here. I would give it a couple extra days. So if I had done that, my trade would have looked like something like this right here. And you see we would have hit max profit. We would exit it. We've been fine. On this one, I would do the same thing. Check out how far it's going to be before we hit. Give it a couple extra days. Something like this. Now here's the neat thing. As things change, your trend line is going to change as well. So right here, it was fine until we hit this level. Now it went there, and now it's even further out. So right now, our trend line is right here because we don't want it to cross candles. When that happens, you can move your stop loss along this trend line. So as things progress, your stop loss is going to follow this trend line. So it's going up, 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 and it's just going to follow and just stay on this trend line until you reach a point where there is no more previous. Then it's just going to stay at your previous level. Additionally, you could set your stop losses at these levels here, which are previous support and resistance again. Does that make sense?
Yeah, it makes sense. So
yeah.
if you were to enter that SPY one today, you would go from today's low and then just do like a trailing, just watch it and do a trailing stop.
So I would look at the day chart. We're almost on this level here. I think because I looked at the RSI and the MACD earlier, I see that we're in a little bit of a red downtrend, but it's pretty much a good time to enter. So here's how my trade would look. I'm going to enter there. My previous low is going to be this one, the previous bounce. It also is another previous support right here. You notice how that all aligns. So we're definitely going to put our stop loss right about there. On my target, we already did the math and figured out it was going to be around 640. We did the math and figured out it was going to be around August to September, so we could go, I think we did 15th. It doesn't really matter as long as you give it enough time to play out. We could go to September 19th if you wanted, because that's another common option. It's going to be a little slightly more expensive, but it'll give you more time. and that's why. So there we go. The 19th. Now we have plenty of time, and here's how this trade's going to play out. Let's see. Where's my lines? I'm looking for my lines. I'm not seeing them. Give me a second here. Okay, we'll just use this. So this is going to do something like this. It's going to bounce. It's going to bounce. Price is going to do something like that. I don't like that. Give me a... There we go. Polyline. That's what I'm looking for. So yeah. Price is going to do something like this. It's going to break. It's going to keep bouncing. Or... And it'll end up here at some point. The other option is that price will continue along. There we go. This is what I use. I couldn't find it. All right. Price continues up. It breaks. And then what happens? It's going to find out a previous low. So probably this low here. Boom. And then it'll continue back up. And so it might have ups and downs and stuff. But, you know, it's going to honor those previous levels of support and resistance. And if it doesn't, then your trade's invalidated and you exit. So if it breaks through this level right here, you're exiting if it continues down. So you don't even wait for it to hit your stop loss because your trade's invalid at that point. So in the event that this does this, bounces, and then it comes back down and makes a new low, I'm entering at this new low before. I might even still be in profit, but I'm entering before it can continue further, because if it breaks wherever we bounce right here, if it breaks that level, it invalidates the trade. And so you want to exit in profit before it even gets there, because it's better to take $5 in profit and be wrong than be wrong and not take profit and then lose money, right?
That's right. I agree with you there.
It just depends, but yeah, you just trail your stop loss up along behind it, and you just take profit at these levels right here, these levels of support and resistance. Boom. You could do one here, here, all good levels, and you just dynamically move your stop loss. One thing I will say is you probably shouldn't put your stop loss in as like a limit order, because Robinhood, if you use Robinhood, sells that information. It's called payment for order flow. They sell it to institutions. They allow the institutions to facilitate it. In exchange, the institutions always know what your plan is and where your stop losses are. So, real thing. Something else that no one has told you probably, but yeah, PFOF, payment for order flow. Practice where a broker receives compensation from a market maker in exchange for writing their clients' trades to that market maker. Market makers benefit to internalize and trade against the order flow. That's why Robinhood offers free commissions, because you are the product. They're making money off selling your trading data to institutions. Webull does the same thing. Questions?
The only question I got is, just send your gamer tag later on, man.
We'll have to do that. All right. Well,
Monday is not really a day that a lot of people like to trade on. Fridays is a day that a lot of people like to close trades on.
Sure.
I'm just closing out with little baby information like that, you know. You don't want to take a trade all the time. 90% of the time, you shouldn't be in a fucking trade.
Yeah, and if you are in a trade, or if you are entering trades, you can enter a trade at any time, personally, but you need to make sure that it's a setup. Otherwise, you'll regret it. Every single time I've not followed my setups or not waited for the trend bounce, I regret it.
I would like to see the beginning of that analysis once again, just the beginning when you drew those trend lines to predict the
On SPY for the swing?
Yeah, for the swing.
Yeah, sure. So we're going to do a trend line off of the first one. We're going to do a horizontal line for our stop loss. We're going to do Fibonacci level from the top of our previous high to our current bottom low. That tells us our level of our price target, which is this 1.27% or 1.27. We're going to use another horizontal line to target that as our take profit. From there, we are going to continue to adjust our trend line as close to the current price without crossing any candles. So right here, it would be here. There's that. Our trade would be a bounce from the trend line, so we're probably coming up on one. We use a previous support level, and if you take it back, you'll notice that this is a previous support level from way back when. So there we go. We got that. That's our stop loss. That's our take profit. And we are looking for it to cross sometime in July, but we're going out to August just to be safe. So there's our trade.
Cedric, are you there?
Yep.
Can you break that down, what Chad said at the very end about selling our info? About the stop loss?
Payment for order flow.
Oh, okay. What is that?
So payment for order flow.
This is your opportunity to break it down. Like
I'm breaking it down.
It like elementary. Do it elementary though. Like make it very simple.
I got you. So payment for order flow is basically where a brokerage like Robinhood or Webull sells your trades to a market maker, so an institution. And so how that works is this right here. You place your limit order here for a trade. Robinhood doesn't buy or sell that for you. They take the data that you put in, say, hey, I want to buy one share at this price, and they send that over to the institutions. The institution's like, hey, thanks for that information. They process your order for you. And then if they want to run your trade or if they want to go against it and hit your stop loss, they'll do that. Then they know when you sell, that's when they step back in and drive the price back up. And they bought your shares.
That's the shit I was talking about.
So yeah, that is true. Market manipulation does happen. It happens on the 1 and the 5, sometimes the 15 minute. But when you get out to the day time frames and larger, they don't have enough money to do that individually. Like,
ooh, okay, Chad, I hear you. You know what? That didn't really click the first time you said.
Yeah,
it,
so
like you didn't. I feel like you weren't hearing me with the.
No. I was hearing you. I was hearing you because you're right. The payment for the order flow is what's happening on those 1 and 5 and 15 minutes. But you go out here and like each one of these candles is the volume is. I'm
with you because guess what?
92.44 million.
Damn! Just in that little candlestick, that's 90 million.
Yes, because that's a whole day's worth of trading.
Yeah. Okay.
So you take that whole thing, you multiply 92.44 million times the price. Who has enough money to buy all that much and drive it, several dollars down?
Elon and Trump.
But that would be like their entire net worth.
I'm saying, that's what we think. You think that's what they net worth is. Got some money we don't know shit about.
Maybe
market money.
Well, maybe,
I don't know.
but what moves the markets? What moves the markets on the higher time frame is news. So big news events. That's what this stuff is. But what happens?
They think retail traders don't have enough money to move the market. You know that, right? They think we broke.
Well, they don't individually, but retail traders do make up 40% of option trades on the New York Stock Exchange now. So almost half now. Yeah.
Yeah. Now. Yeah.
Previously, they never did.
Yeah, right.
Well, options were previously reserved for like institutionals, professional traders, hedge funds, banks, things like that. Once Robinhood and other people made these commission-free and these open brokerages for retail traders to be able to trade options, they became much more streamlined and mainstream. And the reason why you can get a 30-cent option on Robinhood is because the payment for order flow. They're telling you what you're buying, when you're buying it, when you're selling it. what your stop loss is. If you program it in, they know your stop loss. If you use this trend line, they don't know your stop loss.
So if that happens, so you get stopped out, do you just get right back into it if you want to? I mean,
so
that's
the first,
crazy.
yeah. So the first thing, there's several levels here. The first thing is to be aware that it's happening, because a lot of people have no idea.
Okay.
The second level is to never place stop limit orders through your Robinhood app. Always use a price level, and you can go into Robinhood and you can do a. I'll just show you here. It's a little different, but you go in there, you hit the notification bell, and you put add an alert, and that'll ding whenever the price hits that, and that's when you know to sell. It'll send you a notification. Hey, price is at $5.70. Then you can step in and sell it there.
Now that's different. Now that's different than. But Chad, see, the reason why we would use the stop limit is because some of us be at work and don't got the time to manually do that, and the stop limit is helpful. But that's why I say sometimes you got to be willing to drop that stop limit down to a level where it won't reach.
So here's my counterpoint to that. If you don't have as much time to manage your positions and to monitor your positions, you should not be day trading. You should be swing trading, because you don't need much time.
And no, for sure. That's what I'm saying. Before you told, I learned something from you today, Chad, which is specific. The main thing I learned from you today was the reason why that strategy doesn't work on day trading. I've been using that strategy though before to day trade, and it just don't work because of those stop loss situations. So I figured that's where they come into play at. But swing trading feels better. It feels better. It takes away a lot of that stress that you feel day trading.
And if you're going to day trade, you have to be aware, number one, that that's a thing, because a lot of people are like, oh, that's not a thing. That doesn't really happen. And they'd be absolutely dead wrong, because I watch it happen every single day.
What you talking about?
Market manipulation and banks pushing in. But I know the institutional trading plans. I know how they trade. I have actually in my possession I'll just show you. Give me a second.
So that's why you say that the stop loss should be even lower, right?
Yeah,
Okay.
but not anymore.
Yes, but this right here.
Just swing it, okay? Don't necessarily don't risk more. But I was saying that because, that is a saying that the more you risk, the bigger the risk, the bigger the reward most of the time, right? But it makes more sense to swing. You got to have a lot of capital to be a day trader. That's why they tell you 25 grand.
Well, I mean, I don't necessarily agree with that. You don't necessarally have to have a lot of capital. Well,
I think that's a good idea.
So yeah,
if
it's good to have
25 grand, you shouldn't be fucking doing it.
No, I know a lot of people who trade with like $2,000 or $5,000 full time.
Yeah, okay, cool. Day trading. I'm talking about like these people and you can lose that now. Let's be clear. That can lose that same $2,000. But the people that are comfortably day trading, they got 25 grand at all times in their account. They're not day trading with the 25.
Not all of them. In fact, I would say there's a lot of them who don't have that.
Paper trade with $1 million and watch how easy it is to make money when you got.
For sure. That's easy.
That's all I'm saying. Like I'm just saying. Yeah, I may be wording it wrong, but
here's the thing. Here's the thing with that, Cedric.
The more money you got, the easier it is.
Oh yeah, that's 100% true. The deal with being able to trade with a small account and be profitable day trading on a short time frame and such requires to know what is happening and why in the market. It just comes down to that, because I know people who do $500, $2,000, and that's their max amount that they have, and they trade it every single day, and they're making $500 a day with $2,000 or with $5,000.
That is not the average trader, though.
But I'll tell you what separates them from everyone else, though.
Right.
There's an understanding of what's going on in the market, and there's an adaptability. The biggest thing you can have as a trader, as a day trader, is being able to be adaptable and quick reactions to news, to things like this. So
Yes,
let me
now-
guys show you this, because this is really interesting. You guys probably haven't seen something like this before, but this is a real institutional trading plan. Okay,
Yeah,
this
JB,
outlines
but,
institutional strategy, how they trade, why they're trading it, what's going on, and all of their information in it. Okay, this is a very real strategy, and it all
JB, you there?
it basically puts into words what they're doing and why they're doing it. If you know this stuff, you have an edge on the market, and the edge is you can come in here and you can see, okay, I know institutions are looking for a gap fill. Let's see. Let me find my rectangle tool. They're
Yeah,
looking for a gap
adaptability.
fill on this single candle right here. And what's going to happen is you'll notice patterns in the market that you've never seen before of things like this right here. You have these areas of supply and demand, and you'll notice price moves in between them, but it moves at an opposite rate. It comes out, comes back in, and that's when it boosts. So what institutions know, and what these other traders know, is that when you fall back into a level of this supply and demand, you set up for a trade, a perfect short trade here. You wait for it to leave with volume. So here's where it leaves with volume. Right here on this candle, you set up your stop loss on the top of that level, just outside of it. Let me turn off the magnet here. And you set your entry right there. And you go for the next one. And you make money like this all day long. But this is better for like futures.
Fine.
But they'll do this right here, and the market moves in these waves. It's fractal, but it moves between supply and demand zones. That's what happens. And every time you have a strong volume swing low or swing high, that's another opportunity for a target or for a trade entry. So like in this case here, we came in, we bounced. This right here would be a perfect long opportunity. Now you could wait for it. See right here, boom, and we're going right back up to this level.
JB,
Yes.
when he was talking about adaptability, but before that, you asked the question and he answered it with that answer with the adaptability, because sometimes, yeah, if my stop loss, it has happened plenty of times, I get stopped out and I will re-enter the trade going in the opposite direction since I know that I picked the wrong direction. And
I wouldn't do
to it.
that. I wouldn't do that.
I'm just saying. I'm just saying I've done it before, but it's, and the reason why is because I caught on to me being in the wrong direction fast. This is on the scalping side though, and this was like for future. So no, I wouldn't do it, but I have done it before, and it's like it's if your take on something is bearish and you're obviously fucking wrong, don't keep entering the same position. Don't keep going in the same direction. You're wrong. Go with the trend.
Right.
Adapt is what I'm saying. Adapt. Go ahead. You want to re-enter the trade? Don't re-enter the same position. If you're wrong, you're wrong. Don't revenge trade, especially. But that's a whole nother topic. But I'm just saying, if you were bearish and the shit is a bullish day, and you want to enter more than one trade, and it's obviously going up, don't be hard headed. Like no, learn to adapt. Don't re-enter the trade. Adapt to what the market is doing. You thought it was going down. Okay, it isn't. It's going up. It's clearly going up. Too many things pointing at it going up, and you just still buying fucking puts, or it's going down and you still buying calls. Being very delusional, thinking something magic or mysteriously gonna happen or miraculously gonna happen to make it go in your direction.
So does that also apply to the swing trades? How they can come in and stop you?
No.
No, Chad just broke that down and he
Okay.
just broke it down. They don't got enough money to do it.
Yeah,
Okay,
there's not an individual that can there's not one single individual, unless it's like a a crazy event, which is illegal, by the way, where everyone comes together and says, hey, we're all going to buy or we're all going to sell at the exact same time. And then what happens is usually...
Go watch Dumb Money. Go watch Dumb Money. It
Well,
kind of happened.
Well,
but
here's
it
what
didn't happen,
here's what
but it
happens.
kinda
The SEC will freeze those. They won't allow those to go through.
It happened. It did happen, actually. So, yeah, guess what? Go watch the... I don't want to spoil the movie for you, JB, because you're going to love it. But go check it out.
Right, but because of stuff like that, I'll show you this interesting information here.
And it's based on a true story. It actually happened. They actually took him to court, but I'm not going to say no more than that because I don't want to spoil it for you.
I'm going to show you guys something, but now they have rules and regulations, and I'm going to show you something really, really interesting.
Swing trading is just, it just is more appealing now. The more and more I get to know, like, everything about
trading. Yeah, it's much safer.
Yeah.
I want to show you guys a really interesting thing, because you're right, it has happened, but it can't happen anymore, and the reason why is because, let's see, I'm going to look for, let me reset this. I'm going to look for some really expensive trades here. I'm going to show you guys something you probably have not seen or heard about before. Okay, so these are $50 million trades that are going through. I want to show you... Not looking for that. Let's see. Flow alerts. I'm trying to find my canceled trades. Bear with me just 1 second. On like a low volume stock, they will place a trade and the SEC will step in and prevent that trade from going through. All right, so these right here, floor trades, are what the actual floor is trading. Let me see. Or like the actual, these are trades that are placed on the New York Stock Exchange floor. Like, these aren't through a brokerage. These are through the stock exchange. They're in person. Trying to find... Trying to find a good example for you.
My bad. Walk, come get the ball.
Sorry, I'm just trying to find... That's what we want right here. Okay, so these are trades that tried to go through that were canceled today. Or actually, these were all 6:05. I think I have a date filter set on. But basically, some of these trades will be canceled because of their size or their volume, or will move the market or the underlying too much, and so they prevent them from placing those trades and either make them break them up into small sizes and ease them in. But they're there to prevent something like that from happening. So if all of these people went through and tried to do it at the same time and had a gentleman's agreement to all buy into the stock market, it wouldn't happen because it would move the market too much and it would be blocked. It just wouldn't be allowed. And that's because of things that have happened in the past where people would either spam fill orders, then cancel them before they were filled in order to manipulate the market. So these are countermeasures that are in place due to previous market manipulation attempts. So the newest thing is on the 5 and the 15 minute, they will do large orders and they'll time it right so that it breaks stop losses. And that's legal. It's not great, but it is legal. So there's nothing really we can do on that. But yeah. Any other questions? Anything else before we call it a day?
I'm good. Thank you,
Okay.
chat.
All right. Well, thank you guys. I am going to call it here. It's been a pretty good day. We've talked about a lot. We've gone on for probably a long time. It's going to be a really long video, but hope everyone has a great day. Happy trading, and we'll see you next time.